Welcome to the Radio Revenue Podcast. Today, we're embarking on a deep dive. We're looking into corporate strategy, financial health, and our focus. It's Deckers Outdoor Corporation. You probably know them, UGG, HOKA, those iconic brands. We're using their latest annual report, the Form 10K, for the fiscal year ending March 31st, 2025. Now, for anyone maybe not familiar, the 10K, it's this really comprehensive report public companies file. It's got everything: audited financials, business descriptions, risks, what management thinks. It's packed. Basically, it's the best public document you can get on how a company really works. Our mission today, to pull out the key nuggets, the important insights from this, well, pretty extensive document. Okay, let's unpack this.
Exactly. And, understanding a 10K, it isn't just about crunching numbers. It's really a shortcut to being properly informed about a company, what goes on inside. You get this detailed picture, their financial health, yes, but also the challenge is their strategy. It lets you see behind the headlines.
Right, into the core operations. So Deckers, at its heart, they're a global leader, designing, marketing, distributing innovative stuff, footwear, apparel, accessories, and they cater to, well, both everyday casual life and high-performance activities. They mainly market under 5 brands they own: UGG, HOKA, Teva, AHNU, and Koolaburra.
And what's key here is how these brands operate. They aren't just sitting there. They compete actively across really diverse markets: fashion, casual lifestyle, running, outdoor sports. And Deckers has this deliberate strategy, you see it in the filing, to differentiate based on fashion, authenticity, functionality, quality, and comfort.
That makes sense. Kind of stand out.
Absolutely. Crucial in crowded markets.
And speaking of the brands, there's been some recent strategic shuffling. They started phasing out Koolaburra's standalone operations. That was third quarter fiscal 25. Koolaburra.com was closed by March 31st, 2025, and they're planning to wind down the wholesale side by the end of calendar year 2025. So what does this move, this divestiture, signal about their bigger picture strategy?
Well, if you connect the dots, it really signals a sharp focus. They talk about their most significant organic opportunities. It's a pretty clear shift in where they're putting their resources, streamlining the portfolio, concentrating efforts.
Focusing on the biggest growth areas.
Exactly. Not spreading themselves too thin.
And there was another big structural change, that 6-for-1 forward stock split. Took effect September 13th, 2024. The stock started trading post-split on the 17th. And alongside that, they proportionally increased the authorized shares from 125 million up to 750 million. So, okay, a stock split makes shares cheaper, more accessible. But what does this specific move, the 6-for-1 split, tell us?
Right. Beyond just making it cheaper per share, that 6-for-1 split, it's a strategic signal. It suggests they might be trying to broaden their base of retail investors,
Yeah.
individual people buying stock. Lowering the entry price could tap into a wider pool, potentially impacting trading volume, market perception. It definitely signals confidence from them about growth and liquidity.
Okay, that makes sense. Now let's dive into the numbers. Because Deckers really had an impressive fiscal year, ending March 31st, 2025. We're talking a big jump in net sales from, what, $4.29 billion in FY24?
Up to $4.99 billion in FY24.
Yeah, that's a 16.3% increase. That's pretty robust. What drove that?
Primarily, the report says higher net sales and higher operating margins. So they're selling more and they're making more profit on each sale. Plus, their total other income also went up. That was mainly higher interest income from higher invested cash balances. So good cash management, too.
Good point. And it wasn't just the top line. Profitability surged, too. Net income jumped, what was it, 27.2%?
That's right, up to $966.1 million.
From $759.6 million the year before. And for you listening, that means basic earnings per share, the EPS, grew over 30%, from $4.89 to $6.36. That kind of bottom line growth, it signals real efficiency, maybe some pricing power.
And if we dig into how they sold that stuff, their direct-to-consumer channel, the DTC, huge growth there, saw a 26.5% increase. That really outpaced their wholesale channel, which grew 12.6%.
Right. And DTC, the 10K clarifies, that's their websites and their own retail stores. They call it an omni-channel marketplace. So from your perspective, why is this DTC push so vital? I mean, beyond the obvious margin benefits.
Well, it's about more than just margins. Those are nice. It's really about owning that customer relationship end to end. For Deckers, that means getting richer data on what people want, direct feedback, the ability to, react quickly with products and marketing.
So it gives them an edge.
Significant competitive edge, yeah, especially in a market that moves as fast as fashion and footwear.
Makes sense. What about geographically?
Geographically, domestic sales were strong, up 16.8%. but international actually grew faster, 21.1% growth there.
Interesting.
And within the big brands, UGG is still obviously a powerhouse, but HOK actually hit a higher operating margin, 39.8% for HOK versus 35.9% for UGG.
Wow. And that HOK growth, it's fascinating how it helps with seasonality, isn't it? UGG has that traditional big spike in the third fiscal quarter, fall and winter. But HOK's sales are more spread out through the year.
Right, which gives them a much more consistent revenue stream overall. It definitely helps de-risk things.
Okay, so strong sales, smart channel strategy. But how do they actually make all this stuff? Let's look at operations, supply chain.
Yeah, to understand the results, you need to look behind the curtain. It's interesting, they don't actually make their own products. It's all done by independent third-party contractors,
Hmm.
and most of those are in Southeast Asia, with a really big footprint in Vietnam.
And raw materials. That UGG sheepskin must be critical.
It is. The 10K mentions it's mainly sourced from specific suppliers in Australia. Then it's processed by just 2 tanneries in China.
2 tanneries, wow.
Yeah, and they use fixed purchasing contracts for sheepskin and also for things like sugarcane-derived EVA foam. It's a way to manage price swings and make sure they actually get the materials they need.
Smart move. Stabilizes costs.
Definitely. And distribution-wise, they run their own centers here in the U.S., Moreno Valley, California, and Mooresville, Indiana.
And international.
Internationally, they're actually making a change, transitioning one of their third-party logistics providers to a new partner. This new partner has an upgraded warehouse management system. That transition starts October 2025.
So constantly investing in efficiency.
Seems like it. It shows they're focused on optimizing that supply chain.
The 10K also mentions their purchasing commitments. Gives you a sense of their planning. They had $956.9 million in purchase obligations for products, mostly with those independent manufacturers.
Yeah.
Expected to be fulfilled pretty quickly, less than a year.
Right. And on top of that, another $231.3 million committed for commodities, the sheepskin, the EVA foam.
Now, these sales, these strategies, they don't happen for free. It takes investment. And here's where you see their commitment to future growth. Capital expenditures, CapEx. They're estimating $120 million to $130 million for the upcoming fiscal year. So where's that money going? What's the most impactful part of that spend, especially thinking about HOK?
A big chunk of that CapEx, it's earmarked for expanding the HOK retail store footprint. Also refreshing existing stores, upgrading IT, upgrading distribution facilities.
So heavy focus on HOK retail.
Yeah, that's particularly impactful. It really shows their confidence in HOK's growth path.
Yeah.
And it's a direct investment in building out that crucial DTC relationship, but in physical spaces this time.
Okay, shifting gears a bit, let's talk people. Culture. Deckers is growing its workforce. About 5,500 employees as of March 31st, 2025. That's up, 14.6% year-over-year?
Yeah, quite a jump.
And the 10K lists their core values. Come as you are, better together, commit to create, own it, and do good and do great.
Yeah.
But values on paper are one thing. What tells you these are actually embedded in the culture, beyond, say, survey data?
That's a fair question. The survey data is impressive. February 2025. 91.5% participation, 89% said they were proud to work there. That's strong. But you also see it in their actions. Their community commitment, for instance. Over $6,000 donated. 24,000 employee volunteer hours in fiscal 25.
Wow, 24,000 hours.
Yeah, things like their Art of Kindness events. It seems like a real demonstration of that do good and do great value. It's not just talk. It ties into their sustainable development goals, too.
And they seem serious about developing talent.
Very. They mention things like Explore Week for learning, global leadership programs, Trailblazers, Navigator, Ascent mentoring, both formal and informal.
So what does that focus on employee development and welfare signal for their business strategy? Is it just about being nice?
Well, it's nice, but it's also strategic. Definitely. In today's market, attracting and keeping good people, especially in specialized areas like design or supply chain, that kind of commitment can be a real differentiator. Can lead to lower turnover, better productivity, more innovation. It's an investment.
And compensation plays a role too, obviously.
Of course. They mentioned competitive salaries, annual cash bonuses, and stock-based compensation for leadership. Things like RSUs, restricted stock units, and LTIP PSUs, which are long-term incentive plan performance share units.
Okay, so those are tied to hitting performance targets.
Exactly. It aligns leadership's long-term interests with the company's success and ultimately shareholder value. Plus, there's a discounted employee stock purchase plan for U.S. employees.
And the benefits package sounds pretty comprehensive too. Health, retirement, parental leave, mental health. even a solar and electric car reimbursement program.
Yeah, quite a package. Seems designed to attract and retain.
Okay, but no business is without challenges. Deckers faces risks too.
Absolutely. They operate in what the 10K calls a highly competitive industry. Big players out there. Plus, e-commerce makes it easier for new competitors to jump in.
Right. More players fighting for attention.
And a key risk they flag is just how fast consumer preferences and fashion tastes change. It makes predicting demand really tough. Get it wrong, and it hits sales, brand loyalty.
So they need to be nimble.
Constantly agile, yeah. Always innovating, adapting. It's critical in their space.
And standard supply chain risks are there too, right? Relying on overseas manufacturing, geopolitics, natural disasters, labor issues.
All the usual suspects.
Yeah.
But there's one specific material risk they highlight that's quite interesting.
Yeah.
Sheepskin supply.
Ah, back to the sheepskin.
Yeah. It's in high demand, but there are limited suppliers. And they even mention the possibility of legal or social impediments to our ability to use sheepskin down the road.
Like fur bands.
Exactly. They draw that parallel, which sounds like a potentially significant long-term risk for UG, given how central sheepskin is to the brand.
Well, so how are they managing that, and how could changing ethics impact UGG?
Well, the 10K details their current sourcing contracts, but looking ahead, this really underscores the need for ongoing material innovation. Exploring sustainable alternatives, ensuring a super transparent ethical supply chain, it forces companies like Deckers to think beyond traditional materials. It could definitely shape product development and how consumers see the brand in the future.
And like all companies now, they're facing increasing pressure around ESG, right? Environmental, social, governance.
Right.
From investors, regulators like the SEC.
Definitely. But Deckers seems proactive here. They've had an ESG program since 2010, overseen by board committees. They're members of the UN Global Compact, and they align their reporting with major international standards: TCFD for climate risk, GRI for broad sustainability, SASB for industry specifics.
ECFD, GRI, SASB covering the bases.
Right. It's not just about ticking boxes. That level of commitment to reporting standards suggests a pretty robust and transparent approach. It appeals to a wider range of investors now, especially institutional and ethical ones.
Okay, one last risk area, cybersecurity.
Always a concern. They mentioned having a comprehensive cybersecurity program, incident response plan, audits, penetration testing, employee training, the works.
Honestly.
Crucially, they state that over the last 3 years, ending March 31, 2025, cyber threats, even considering past incidents affecting them or third parties, hasn't materially impacted their business or financials.
That's reassuring. Okay, let's switch to shareholder value. How does Deckers aim to create it? Interestingly, they state they have not declared or paid any cash dividends on their common stock, ever.
Right, that's a clear signal. Focus is on reinvesting in the business, driving growth, not immediate cash payouts.
But they do return value through stock buybacks.
Aggressively, it seems. The board authorized $1.2 billion back in July 2022. As of March 31, 2025, there was still $374.7 million left on that authorization.
And then
Just recently, May 21, 2025, they approved another $2.25 billion for share repurchases. That's significant.
So what's the impact of all these buybacks for you, the investor?
Well, the main impact is reducing the number of shares out there. Fewer shares outstanding can boost earnings per share, the EPS number we talked about earlier. So it's seen as another way to return value to shareholders just indirectly compared to a dividend.
And the 10K includes that comparison of cumulative total return graph. That really paints a picture.
It really does. It compares Deckers stock performance against the S&P 500 and an industry-specific index, apparel, accessories, and luxury goods. Starting point is March 2020, index value 100 for everyone. By March 2024, Deckers soared to 702.26, pulled back a bit to 500.46 by March 2025.
Still way ahead.
Massively ahead. The S&P 500 only reached 234.57 in that time, and the industry index ended way down to 86.86.
Wow. So even with some recent pullback, dramatic outperformance against the market and their peers over that 5-year period.
Exceptional performance really stands out.
And one final financial health check. Debt.
Right. They noted no outstanding balances as of March 31, 2025 under their main $400 million credit facility or their smaller $41.3 million China facility.
And they're in compliance with all their loan agreements, their covenants.
Exactly. So they're growing strongly, but they're doing it from a position of real financial strength. Clean balance sheet.
So wrapping this up, what have we learned? We've unpacked Deckers Outdoor Corporation through their 10K. We've seen strong financials, higher sales, better margins, smart brand management like phasing out Koolaburra, focusing on HOKA and UGG, robust operations, even with reliance on third parties, and a clear focus on their people and ESG. It seems like they're investing heavily in the future, especially HOKA, while managing risks pretty proactively.
Yeah, this deep dive really shows a company that's carefully tuning its brand mix, pushing hard on that direct-to-consumer channel. And it leaves you with a question, doesn't it?
Hmm.
As they keep emphasizing sustainability, employee well-being, how will that influence their long-term competitive edge?
Yeah.
Especially as consumer attitudes and regulations keep evolving globally. It's something to watch.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.